All right, it is Friday, and as you know, on Friday we do our Friday financial news wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing great, man. I really do appreciate this. The ability to do the fact that I know I'm doing this with you every week just brings me joy because I get to summarize an entire week. I know I create a lot of content, 5 videos a day. Most people can't watch that much. Even I get tired of myself. I get it. But the ability to come back and watch this Friday wrap up, one video, 15 minutes, very powerful. So thank you for doing this with me.
I love it. And I also get to ask you questions, and I've got a great question for you that we're going to hold at the end.
Oh, okay.
So, yeah. Something that we've talked about in the past. So I think it's very relevant and
Sure.
Something that's been brewing with me all week. So let's get into it. So the Fed triple threat, what is that all about?
Yeah. I've been telling folks, we've been talking about the Fed's coming, raising rates, tapering, all this gobbledygook. I think what a lot of people were surprised is the Fed's actually going to be doing three things to try to beat back inflation, right? The Fed was wrong. Inflation is not transitory. We'll talk about the actual numbers here in a minute, but it's a problem and it's a growing problem. So first off, the Fed's going to start tapering. What does that mean? Well, they've been buying hundreds of billions of dollars in bond, and every time they do that, they are injecting capital. So the first rule of thumb is if you want to stop digging a hole, stop digging. So they're going to stop digging, and that's called tapering. Number two, one of the things we must do in the economy is there are a lot of people that are borrowing at or near zero that are frankly doing stupid deals. But in reality, it makes sense, right? If you can borrow at zero and earn 2, how much money do you want? The answer is all of it. That's just how it works. So again, a lot of capital is being treated poorly, which it is today. It's basically free. A lot of dumb things going down, a lot of zombie companies, just bad stuff. So rates are going up. People expected those. But what people forgot, the triple threat, is the Fed now has an $8 or $9 trillion balance sheet. Let's just say that's the biggest of all time. It's the biggest of all time by factors like 5, 6, 7, 8 times. And what does that mean? Well, instead of being a buyer, i.e. digging, they are now going to become a seller. They're going to become a seller of bonds, which is going to extract cash from the system. And oh, by the way, they do not have to make a profit. So in order for them to sell bonds, what happens in that market is rates may go up and the bond may go down. So by the Fed becoming no longer the biggest buyer, but potentially the biggest seller, stuff about to get interesting. And it's about to get interesting in very interesting ways. We tried this in 2018. The Fed got spooked. Real estate market took a Q4 hiccup. If you were selling, if you were flipping in Q4, you didn't know what happened. I remember I was doing it. And yeah, it's about to get interesting. The Fed's triple threat is going to cause a lot of pain to a lot of people that are not paying attention. But if you're watching this channel, you're watching our Friday wrap up, you know you need to be preparing because the economy is going to be having fits and starts come the summertime. So be careful.
Be careful. Very well said. It's interesting. I'm in this week, I'm in a Tony Robbins event called Business Mastery. Awesome. Just back to the basics. And one of the things, what a huge distinction of, a true business owner is the ability to anticipate.
Yeah.
And that's what you're talking about right now. And I want the audience to really get what he's really sharing, the information, the content that he puts out on a daily basis. It gives us as the mom and pop investor, the ability to anticipate. So,
and let's be clear, I'm in that camp. I'm a mom and pop investor. The reason the only thing I'm doing different in my life is I'm taking notes and reading it to a camera in the morning. I would do everything I'm doing for the daily financial news. That's now 1,000 days in a row. I would do it anyway. So I do this as much for you as for me. So thank you.
I love it. I love it. So let's continue. Let's talk about CPI. What's going on with CPI and inflation?
CPI, Consumer Price Index, it's just comical at this point. It's what we've been talking about. Last month, we talked about it was 6.8, highest in 40 years. Well, it went higher. It's now 7%. And just like last month, Ty, I went back and did the math. Inside the CPI number, the largest contributor to it is rent, or what they call it, rent equivalent. I peeled it out. Rent equivalent this month was 3.2%. To say that is reality is, I don't know, somewhere between comical and a train wreck. And the reality is it's somewhere between 14 and 17%. So I backed out 3.2, put in 14, and actual CPI, which last month was 10, is now 10.2. Yeah, double digit CPI inflation, not good, very bad. It's why we talked about the Fed's triple threat in number one.
Very interesting. So from CPI, Consumer Price Index, let's go to PPI. What is PPI and what's going on there?
PPI is Producer Price Index. It's often thought about as the wholesaler prices, right? It's that first indication of what might be coming in CPI, right? Because it all starts at the producer, right? So PPI, it is up as well. It's I think it was 9.8%, up from 9.7. Again, not great, almost double digit. Just inflation is real. It is everywhere. Wages up. It's everywhere. We even have Jamie Dimon, JP Morgan Chase today saying wages are going to be a factor. Everybody thinks wages is like minimum wage. Oh, the guy at the restaurant, the person working retail. Jamie Dimon, Wall Street money, people making bank, multiple six figures. Jamie Dimon is saying we are having to raise compensation to compete for talent. Wage inflation may start at the bottom, but it will go through the entire stack. That is why wage inflation is going to be a multi-year, and I've said repeatedly, at least a 5-year environment. And if you know how to use inflation, you can get rich, but you got to be careful. So yeah, inflation is not transitory. It's here to stay for a while.
It is here to stay. So let's move on to our next topic, which is earnings. What did you see this week in earnings?
Yeah, so earnings really are going to start in earnest next week, but we got a couple of indicators today. The big banks, JP Morgan, Wells Fargo, Citigroup today. Basically, they beat Q4, which, no kidding, it was pretty easy to do. But people are really starting to go. Jamie Dimon, CFO, says, I don't know if we can hit our internal targets for 2 years. Think about that. CFO of the best bank on Wall Street, they have an internal target of 17% cash on cash. That's what they expect. That is how they measure. And their CFO said, in this environment, with an expected 8% increase in expenses, with a uncertain investing landscape, we are not going to hit it for up to 2 years. That should send shivers through the rest of Wall Street, the rest of investing, because it is going to become dicey. Then we saw retailers like Albertsons report basically saying input costs can't keep people. It's just a mess right now. Again, this is what's going on, and it's going to be. I think most of the companies, at least the largest percentage of the S&P 500, report next week. Here's the deal: don't look at Q4. Look for their future guidance, because I don't think it's going to be as rosy as people think.
Very interesting. So if I can maybe, let me just make sure that I understand this. Sure. And I want to clarify for the viewer at home.
Please.
So with the stock market, obviously earnings is a big deal. Mm-hmm. We're going to hear about Q4 earnings as we go into next week. We've heard a little bit just recently, but ultimately we believe, and what you're saying is that Q4 numbers are probably going to be in line with what expectations were. Mm-hmm. Is that right?
Yeah, absolutely.
But they're also, one of the things when they do earnings announcements is they talk about anticipation.
Yeah, forward guidance.
CEOs, forecasts, CFOs. They're going to also be talking about what's to come in the expectations, and expect that news could be a little dicey, could be a little rough, could maybe anticipate that there may be some bad news as we get into next week about what's to come. Is that accurate?
Well, I think of Jamie Dimon, who JP Morgan Chase is the best bank on Wall Street. If they're looking at the economy and they're basically saying, not sure. And again, as a CEO, as a company, when you're not sure, you got to tell the world. This is Jamie Dimon telling the world that the next 2 years, he just doesn't know. And again, as somebody who makes his own family decisions, when I hear Jamie Dimon, who, oh, by the way, expects a 17% cash on cash return, to go, not sure, that gives me pause. So we'll see what the rest of the S&P 500 has to say.
Well, make sure to watch next week, because next week will be very interesting.
Amen.
We're obviously going to have some interesting news to talk about with earnings. Watch for that next week. So let me transition to our favorite topic, which is real estate, the real estate market. How does all of this let's connect the dots for the viewer.
Sure.
How do you see this playing out in our current real estate economy?
Yeah. So the real estate economy is very interesting because it is built on consumers, cost of capital, and people are people. And what I mean by that is they don't always operate like you think they will. So what has happened in the real estate market just in the last week? Well, first and foremost, rates are up. One of my weekly experts is Matt, the mortgage guy. Rates are up between 1.25% in a week. And that's a big deal, right? Between owner occ and investment loans, they're up. But here's the deal. You would think if rates go up 0.5 point, that real estate transaction would fall because it's more expensive. Well, mom and pop don't act that way. If you were on the fence and you just got hit with a 0.25 point rate rise and you still want to buy, you're probably going to start writing offers because it's not the first quarter that you missed. It's you telling yourself, I don't want to miss the next quarter or the next half. So what you're going to see in the real estate market is, I'm guessing about 6 to 8 weeks, that demand that was on the fence is going to be pulled forward. Unfortunately, that's going to be pulled forward into an environment that has record low inventory. So I think we're going to have a pretty hyperactive 8 weeks. Yeah. After that, don't know, because I think rates might run. And if it runs too fast, too far, it might create an air gap like we saw in 2018. If you were in the market in 2018 Q4, you know what it felt like when the Fed raised rates one too many times and it caused an air pocket in your demand. I knew flippers that went from having 50 showings to 0, right? Seemingly 2 weekends apart. So this can happen. But in the short term, I expect all the people sitting on the sidelines to come in. But if rates keep racing ahead, we may create our own air pocket. So for me, that'll be great. What do I want? I want more demand. I want more supply. I want more supply. I'm okay with rates going up because, again, I do cash flow, yield, all that stuff. Don't care. I don't care what the rate is because I'll just put that in my spreadsheet. But yeah, I want the market to slow down. Unfortunately, I don't think it's going to happen in the next 6 to 8 weeks, but maybe come March, April, May, maybe it slows down if rates jump. So we'll see.
Very interesting. So, and I want to comment on this because I completely agree with you. The low inventory is still, the inventory is low. There hasn't been a big spike up. Obviously, we're only into the second week of the year so far. So everything's in alignment. But I would agree with you that that it's interesting because everybody that I've talked to over the last 6 months, myself as a salesperson, as a deal maker, as a transaction engineer, anybody that I've talked to in the last 6 months, I've had so many people calling me, following up with me, texting me, saying, hey, we're really serious about doing this. We need to do something. So I can see two things. One is that seeing the inventory spike a little bit or normalize.
Okay. Nice.
Probably going into maybe February, March.
Yeah.
That would be my anticipation. When you talk about an air pocket too, and I just want to translate that to the audience, it's not a crash.
Oh, God, no.
It's not a crash, but it's where all of a sudden, that property that is in a 425 neighborhood that might have had 10 offers and sell for 450, all of a sudden now at 429, it's a little slow and it's not flying off the shelf the first weekend or the first week, or even maybe the first 2 weeks. Yeah. It's not just flying off the shelf. Is that what you would describe as an air pocket?
Yeah, people always want to translate what I say into price. So when I talk about an air pocket, I'm talking about transactions. Transactions will slow down, which means inventory will naturally build, days on market will expand. And that house probably still sells at 429 in this example. But you know what? Oh my God, it might take 30 days.
Got it.
What's going to happen.
Got it. So then my last question, and this is how we'll complete, and this is interesting because I think it's really relevant. The Fed's triple threat, tapering, seeing the market slow down, which is what you've talked about for a long time. Obviously, I believe that's something that we're going to start to see here as we get into the early spring. My thought for you is this, something that we've talked about, something that's in the book, by the way, in your story, single family assets, continuing to buy single family versus when kind of in where we're at, the state of the union in real estate investing today, when do you anticipate the idea of, okay, now we start 1031 exchanging single families and we turn, 10 houses into 50 apartment doors.
Yeah.
Or what's your kind of thoughts about that monopoly play there of going from houses to multifamily?
First
Big
and
market.
foremost,
Yeah.
I look forward to doing that again. It's a big part of our journey. We go from 8 to 80. Read it. It's in the book. For me, it's all about affordability, right? I talk about in the book Affordability Index. And in my market of Fresno, California, it's not all markets, but my market is still really healthy. It's still very affordable. It's still about a 40. And again, in the book, I talk about I'll get nervous if it goes down to 25. And for me, that's probably, that could happen later this year. Because again, affordability is very powerful. It's price, it's interest rates, and it's income, right? It's that third one that all these little YouTubers don't understand. It's income. Again, yes, rates are up. Yes, prices are up. But you know what? So are wages. Wages are up. And again, you can afford more if your wage goes up. It's just math, right? So for me, that's what I'll be watching. And I think it's going to happen. And again, I'm buying on purpose residential because in my market, it's a better deal. I look at apartments, but right now apartments still have stupid pricing. We have people, Ty, repeating the mistakes of 06. What happened in 06? People got bad debt structures, 2 and 28s, liar loans, neg am, but it was very residential. It was lending that blew up. Today, we have people in multifamily getting bad debt structures, mezzanine financing, short-term bridge loans. They're interest-only loans. They're doing all the stupid things in apartments today that happen in real estate. It will crash, but right now we're still in the feeding frenzy of bad deal structures. So that will happen. That will blow up. It's probably 2 years out. And guess what? It'll probably be right about the time that my housing explodes higher. And then I will 1031 into apartments or multifamily. So I'm going to repeat that step that I did in my book. It was very powerful last time, and I want to do it again.
I love it. I love it. So folks, stay tuned. Stay tuned, because you know what? Again, if you're following the content, Michael is a player in the game. He's not somebody just talking about it. He actually has inventory. He actually has doors, lots of doors. He's as concerned, maybe even more concerned, because of his level of participation in the real estate market. So Michael, thank you for all that you do. I really appreciate doing these. I just want to encourage everybody. Here they are.
Woohoo!
The 2 books, One Rental at a Time, and then the Conversations with the Real Estate Millionaires. Great books. You can find them on Amazon. By the way, I just sent out, 20 of these.
Oh, nice.
20 books. I just gifted 20 of these people from the giveaway, as well as people that are involved with us, foundation builders, the mentorship, all of that. I want to encourage you, if you've received the book and you watch the channel and you have not yet given Michael a review, please go on to Amazon, give this man a 5-star review. Let him, just really quick. It's easy. Get on there, give him a review. Michael, thank you for all that you do. Have a great weekend, brother. Thank you.
Thanks, buddy.